I love ETFs as much as the next investor, but after spending weeks digging through expense ratios, performance data, and fund mechanics, I am genuinely shocked at what people are putting their money into. Some of these products are financial traps dressed up in respectable packaging. By the end of this video, you will know exactly what to avoid before you lose another dollar. In the 10th place, the United States Natural Gas Fund, ticker UNG, stands as a warning shot for anyone who thinks commodity exchange-traded funds are a shortcut to easy profits. UNG promises exposure to natural gas, but what it actually delivers is a masterclass in hidden losses. In 2025, while the Bloomberg Natural Gas Index managed a modest 3.7% gain, UNG investors watched their money shrink by 27.07%. That means $10,000 turned into just $7,293 gone, even though the spot price went up. The culprit is the fund's relentless monthly roll of front-month NYMEX futures, forcing investors to buy high and sell low every cycle because of contango. Add a 1.28% annual expense ratio and the drag is relentless. UNG does not just underperform, it quietly drains capital year after year, showing how a legit exchange-traded fund label can mask a structural money pit. Number 9. ProShares VIX Short-Term Futures ETF, or VIXY, takes the idea of structural decay to a whole new level. This fund does not track the VIX index itself, it is chained to a daily rolling basket of VIX futures, which means it is bleeding value almost every single day. In 2025, VIXY's net asset value plunged 41.2%, even before you factor in its 0.89% expense ratio. The reason is simple and brutal: VIX futures almost always trade in contango, so the fund is forced to buy pricier contracts and sell cheaper ones day after day. That is volatility decay in action. As one industry analyst put it, long volatility ETFs are built to melt. For anyone thinking this is a safe hedge or a clever play on market fear, the reality is you are paying premium insurance on a house that rarely burns while your principal quietly disappears. 8th place goes to the Teucrium WEAT fund, WEAT. This fund is supposed to track wheat prices, but in reality it's a masterclass in hidden agricultural risk. Unlike oil or gas exchange-traded funds that get crushed by constant contango, WEAT's danger is subtler. The fund tracks wheat futures, not the actual grain, and those contracts are shaped by the quirks of the harvest and planting calendar. Every year, basis risk swings with the seasons, making the fund's performance drift away from spot wheat prices. In 2025, while wheat prices barely budged, wheat's net asset value slipped 6.5%. That's before you even count the 0.95% annual fee. Throw in thin liquidity in the front-month contracts and you are left with a product that charges real money for exposure to a financial instrument that does not actually match the crop in the ground. For anyone thinking commodity exchange-traded funds are a shortcut to real assets, WEAT is proof that the wrapper can be just as risky as what's inside. Number 7. Grayscale Ethereum Trust, better known as ETHE, turns the crypto ETF dream into a lesson in financial engineering gone wrong. On paper, ETHE lets you buy exposure to Ethereum without the hassle of wallets or private keys. In reality, what you get is a trust that trades over the counter, often at a price wildly disconnected from the actual value of the Ethereum it holds. In 2025, the net asset value of ETHE fell 14.2%, but shares traded at a 13.8% discount, a complete reversal from the days when premiums soared past 30%. The problem is baked into the trust structure. You cannot redeem your shares for real ETH, so if the market sours, you are stuck selling at whatever discount the crowd demands. Meanwhile, Grayscale collects a 0.95% annual fee for the privilege, money straight out of your pocket regardless of how the trust performs. For anyone thinking ETHE is a simple way to own Ethereum, the truth is you are buying a financial wrapper that can quietly siphon your returns, all while tracking the wrong price. If you want actual crypto exposure, there are now spot ETFs and direct options that do not chain you to a trust with broken mechanics. Number 6. The so-called Timberland ETF, TMFM, shows just how quietly a fund can trap investors with a flaw you will not see until it is too late. TMFM owns illiquid real assets like Timberland, but here is the catch. Its net asset value is only updated twice a year based on slow-moving appraisals. If timber prices plunge in the real world, the fund's reported value just sits there, lagging reality. In a crisis, anyone trying to sell is forced to accept a stale, inflated net asset value. while buyers disappear. Imagine a sudden 15% drop in timber prices. Your shares might only reflect that months later, long after the damage is done. For retail investors, that is a classic exit price trap. It looks stable on paper, but the real risk is hidden in the delay. When stress hits, the losses become real, and by then you are already stuck. Number 5. Advisor Shares Boosted Anti-Beta Tactical ETF, ticker BTAL, sells itself as a clever way to dodge market crashes. The pitch sounds sophisticated. Go long low beta stocks, short high beta stocks, rebalance every month, and you will supposedly sidestep the worst of Wall Street's wild swings. But here's what actually happens. That constant monthly reshuffling is not free. Every rebalance means more trades, more hidden costs, and more chances for the fund to get whipsawed by sector shifts. The result in 2025, while the S&P 500 powered ahead with double-digit gains, BTAL lagged the index by a full 8%, and that is before you even account for its tiered 0.7% management fee. Factor in all the churn and you are lucky to see any real return at all. This is a fund that quietly taxes your portfolio in bull markets, all in the name of protection that rarely pays off for long-term investors. For most people, BTAL is just another case of engineered complexity that chips away at your wealth month after month. Number 4. MAXI, the Bitcoin Strategy Plus Income ETF, takes complexity to a whole new level, and not in a good way. On the surface, MAXI sounds like a clever way to ride Bitcoin's ups and downs while collecting a steady income stream. In reality, it is a tangle of option overlays and crypto-adjacent equity that quietly bleeds value, even when Bitcoin itself barely moves. The fund loads up on MicroStrategy shares, already a volatile proxy for Bitcoin, and then sells put spreads to juice income. But here is the catch. Those options lose value every single day, a process known as theta decay. In 2025, MAXI's net asset value cratered by 26.8%, even though Bitcoin's price was not in free fall. The culprit is path dependence and option theta, the slow invisible leak of capital as the calendar flips. The fund charges a 0.75% management fee plus a 0.15% performance fee, so you are paying extra for the privilege of watching your money erode. For most investors, MAXI is not a Bitcoin play or an income strategy. It is just a high-fee, high-risk blender that chews up your capital with every passing month. Coming to the top 3, the family of leveraged single-stock ETFs, the 2x and 3x bull and bear funds, have exploded onto the market, with more than 80 new tickers popping up in just the last year. The appeal is obvious: double or triple the daily move of Tesla, Nvidia, or Meta, all wrapped in a tidy ETF. But here is the catch. These funds reset their leverage every single day, which means the compounding math quietly eats your returns alive. In a year when the underlying stock ends up flat but whipsaws up and down, a $10,000 buy and hold stake in a 2x single stock ETF can easily shrink to $5,000 or less. That is not a rare event. It is the default outcome thanks to volatility decay. The more the stock bounces, the more the ETF bleeds. Factor in expense ratios hovering between 0.85% and 1.05%, and you are paying a premium for a product mathematically designed to fail anyone who holds it for longer than a few days. It is not leverage, it is a slow-motion margin call in a shiny wrapper. For retail investors lured by the promise of amplified gains, the reality is simple. These are not investment vehicles. They are trading landmines. The only thing compounding here is your regret. Number 2. Grayscale Chainlink Trust, ticker GLNK, shows just how quickly a shiny new crypto wrapper can punish eager buyers. When GLNK launched in December 2025, it looked like the next big thing, a way to ride the Chainlink wave without dealing with wallets or exchanges. But from day one, the mechanics were stacked against retail investors. The fund opened with a market price more than 5% above its net asset value, a premium created by thin trading and limited share creation. Within 2 weeks, that premium collapsed and the price dropped 3.5%, even though the underlying Chainlink barely moved. For anyone who bought at launch, that's an instant haircut. Money vaporized before the ink was dry on the prospectus. The 0.7% annual fee just adds insult to injury, quietly draining whatever is left. This is not a rare event. It is the default for new crypto trusts with restricted float. GLNK's debut is a textbook example of how retail hype and fund structure can turn a promising asset into a near-instant loss. If you think a new ETF is a ticket to easy gains, remember this: the first exit is always through the gift shop. And finally, in first place, the worst offenders are not just one fund, they are the entire family of so-called butter-style blended or enhanced ETFs. These are the ones with names like Income Plus, Enhanced Yield, or Smart Income, usually packaged with a friendly logo and a promise of high yield with protection. Peel back the branding and what you find is a tangled mess of option overlays, relentless rebalancing, and a fee stack that quietly siphons your returns. The typical expense ratio lands around 0.8% to 1.0%, but that is just the start. Every layer, including option selling, credit overlays, and tactical shifts, adds hidden costs that do not show up in the headline fee. The prospectus might mention option premium income, but what it really means is your upside is capped and your downside is exposed to sudden shocks. Frequent rebalancing means more trading, more friction, and more ways for the fund to bleed out value in choppy markets. It is not unusual for these funds to post a 20 to 30% structural drag in a sideways year, turning a $10,000 investment into $7,500, while the S&P 500 barely budges. All the while, the marketing machine keeps spinning, selling complexity as safety and extracting fees from anyone chasing smart income. The lesson is simple. If you see a fund that promises high yield, downside protection, and a clever-sounding strategy all in one, you are looking at processed financial junk. Real investing is boring for a reason. Do not let a glossy ETF wrapper trick you into paying for engineered decay. Across all these exchange-traded funds, one ugly pattern stands out. Slick branding masks, brutal mechanics that quietly siphon away your wealth. These aren't investments, they're financial junk food engineered to profit someone else. Real investing is simple, patient, and cheap. Don't get fooled by expensive wrappers. Protect your money.